Hi everyone, this time we want to talk about breakouts and stops. Now last time we talked in trends about how we can have these zones and support and resistance zones, and support, resistance and trends become a way that we define a lot of patterns and a lot of, just a simple trend line. Maybe going up and we're looking for a break of that trend line to be telling us when there's been a change in the market. So it's basically the break of those lines, the break out of a pattern, the break out of a trading range that we often look for. And so that's what we're talking about here, defining these things, defining where we would then put stops and how we use stops to help as well. So if you've been trading for a long time, some of these concepts are going to be fairly basic to you, but again, we'll try and get through this one fairly fast, but so that you've got a reference here of things that you need to know for the exams. All right, so let's get into the first slide here. What is a breakout? So essentially, if you look at the chart that we've got here, so we've got a support zone. Now these green arrows were where I added these values, and so essentially they're the ones where we calculate this zone from here. And then the blue are a couple of points. So you can see, that we've got some support here. We didn't break the zone with these two here. But this one here in particular, you're going to have to look really carefully. I'm not sure how clear it's going to come up. You may need to reference the notes that you can download just below. But you'll see that the open and the close actually are above the zone, but you've got this long tail down beneath. If it was a candlestick, then the body would be just really narrow right at the top with a very long shadow underneath. Basically, we wouldn't call that a break of the zone. So when you get these intraday breaks, we don't really count them. We're looking at the close. The close is the most important piece of information. Now, I know some people will use intraday breaks as part of their signals. Totally up to you. From the perspective of the text, you wouldn't be using intraday breaks of a support zone. You're looking for closes to close beyond. So the first time that we actually get a break of this zone is at the red arrow here. And this is where we finally get a close which is below the support zone, and we would call that a breakout. So you need to make sure you remember that. Breakouts are extremely important events. It's a change in the way that supply and demand is a change typically in the trend. May not be the primary trend, depending on what time frame you're looking at, but it does signify a change. Always, with everything we do, it's a trade-off between the risk and the reward. How quickly do you get in there and find the breakout? How quickly do you signal a change in trading? Is always they're going to be that trade-off. All right, let's jump into the next slide here. So how do we confirm a breakout? So when we have a support zone like that, we're looking for closing beyond, outside of that support zone. That's the number one there. We typically ignore intraday breaks, as we said. You could be even a little more conservative and say that you want to have two closes beyond. And that way you filter out the event where one news event drives the price down, but then the next day everyone regains sanity and says, oh no, that's not really as scary as we thought. So that's another one. Again, with all of these things, it's that trade-off between risk and reward, because by waiting, the market may fall even further and you're risking more. But on the flip side, by waiting, you may save yourself by not getting out too early. So those are things that you've got to test with technical analysis. Another idea is to use a point or a percent band around the zone, or just a little bit of a zone, so that you've got a filter, so you're not jumping in and out based on the breaks of a trend line or anything like that. The whole idea is to reduce whipsaw. We talk a lot more about that in moving averages and bands and envelopes. But yeah, that's another way of dealing with these. Another option is to use time. where basically you just say, I'm just going to wait a number of periods. Very similar to multiple closes, but you can just wait a number of periods after the penetration to make sure that that breakout remains confirmed. Examining volume, we talked about this in Dow, we talk about it in chart patterns. Volume confirms trend. So when we get a breakout, our expectation is that volume's going to increase because we've got a change in structure. If you don't see volume increasing on a breakout, very likely that it's not a very serious breakout and price is just going to retrace back in. The other way is using volatility, using beta, standard deviation, ATR. They're all techniques we talk more about in other sessions, but they capture the volatility of the market or the security that you're looking at. We've got a bit of a slide here. So standard deviation, it basically captures the variance between a moving average and all the values. So you've got all the closed values, we get a moving average, which is the average of all those closed values, but each one of them is a certain distance away from that average. That's the variance. Standard deviation is variance squared, and then the square root of it, so it gets rid of positive, negative, and gives a single number. Average true range, it's usually the average of the past 14 true range. Now, true range is the maximum of 3 numbers. It can either be the high to the low of the current bar, it can be yesterday's close to the high, or yesterday's close to the low of today. And we look at those 3 numbers and say, which is the bigger one? That's what we're going to use as the true range for today. And then we average that, simple moving average calculation, and that gives us our average true range. But again, it becomes a fantastic way of measuring volatility. So we do that over 10 or 14 periods. We look at that number, and when stocks are becoming a lot more volatile, that number grows. And then when the volatility disappears, it shrinks back down again. Fantastic. We use that in a number of indicators to measure changes in volatility, and really allows us to work with stocks which are at the same price but have a very different volatility structure. And so average true range is a great one there. Beta is basically looking at standard deviation of price compared to the S&P 500. Or a reference index of some sort. So it basically allows you to define, well, if there's volatility in my security that I'm trading, how is that compared to the volatility in the underlying market? And it lets you see that I've got a stock which is, it's got volatility which is way out of proportion with the rest of the market. There's something going on to, oh, that's okay, we've got some volatility, but the whole market has that. And so the beta doesn't increase in there. It's not susceptible to trend as standard deviation is. And I've got the calculation there, the covariance divided by the variance. We are going to talk a lot more about that later on in the course. So they're the couple of volatility calculations. We've got a chart here that shows on this period of Harley-Davidson, beta. You can see standard deviation and just how these 3 different methods work. Now under here, for each of these 3 lines, we've got them drawn here, so you can see the standard deviation sticks a little bit closer to price. Beta and ATR are a lot closer together and a bit further away from price. So, we could use this as a stop. We're going to talk about stops in a minute. That would be a good one too. All right, pivot point technique. So again, similar to ATR, this is where we're doing a calculation on finding an average, a central average point. We're looking at ranges. And then we're either adding a range above the central average or below. And so it's another way of doing breakouts. Now we're going to do lots of these. There's Bollinger Bands, there's Keltner channels, there's moving average bands. We're going to talk a lot about those. All of these, we have the same sort of breakout system that we would use, and that's where you can look here and say, all right, let's go to the market. Let me find my pointer. So we've got the market well constrained within the band, and then we get this drop. So that's going to be our signal to sell short or to exit a long trade. And then we've got the market going up. it didn't work out so well for us because we actually got a breakout on the upside here. And that would have been a buy. So not saying these breakouts are the best strategies. This is where we've got to test and look at some of this stuff. But again, we get our breakout down, and then you can see that from here, that short trade would have continued on until we got a breakout on the upside. Now, other ways that we use breakouts in envelopes and bands is that often you can say, well, I'll take the breakout on the outside the range of the band, but then when it comes back into the central average, I'll exit there and cover my trades. So, a couple of things there, but looking at these is a great way of doing it. Looking at different time frames is actually something that I would suggest, where you're looking for daily breakouts, but also looking within a weekly context. But that's something that we'll talk more about in coming lessons. Anticipating breakouts. Now, we've talked a lot about primary trend, volume confirming and things like that. As we get prices approaching up to a resistance zone in this case, or a support zone if it was going down, what you're going to find is that the price goes up, but as it goes up into that barrier, it is starting to decline in volume. Now, if you were to see that rise up to the resistance zone and volume was increasing, then the likelihood of breaking through that becomes really, really high. But as it goes up, volume starts decreasing, then likelihood of it failing to break the zone, it becomes very high. And so, even on this slide here, what you can see is that we've got the, I'm just trying to find my pointer, there it is. So we've got the rise here, hit the zone, we come down. Another thing that we watch for is diminishing retracements. So this retracement here, then we go up again and hit the zone, but then the next retracement is smaller. That also is a big key that we're about to break this zone. Now, depending on how aggressive you are, you may decide to take action before the break. It's not recommended. We'd recommend that you wait until the breakout has been confirmed, and then you trade within those ranges, because so many times there could be another retracement and things like that. But these are things that we watch, and these are ways that we can anticipate breakouts here as well. Breakout targets. So, there's a number of different techniques we use. There's a number of different indicators that have been created to give us zones of where we would expect the market to go after a breakout. There's a head and shoulders breakout that we're going to talk about in bar patterns and things like that. But one of the easiest ones to use is just looking at previous levels of support and resistance. Because essentially what's happening is that when we're breaking through, we're breaking previous support resistance, and so we look to where is the next level of support or resistance. Again, we look at this chart here. What we've got is, the red zones have been set through here. There's been a number of lows, probably 3 or 4 bars here that set the red zone that followed through. Got confirmed here again through this zone. And so we're watching this market, and the market's bouncing off it again and again and again, and then suddenly we get the breakout. And as the breakout happens, well, the next thing we're going to look at is, okay, well, where did we have previous support or resistance? So we had massive resistance. This massive run up got stopped at this green line here. So that's a line that I'm going to watch in the future to see what happens. And you can see that the market paused here. Bounced around that line. It was resistance first and then ended up becoming a little bit of support as well, and then pushed on through. But again, that once it pushes on through that, the next thing I'm looking at is, well, where is my next levels? And you can see again that these levels here, from these peaks in the market, are being used as resistance back into the future. And that's what you're going to see happen time and time again. So that's why these levels are important. We can use them as breakout targets. So we've got an idea of where do we think the price is going to go. This is a really key, important thing from a risk to reward basis. You see, if I was taking a trade there at that breakout, and I measured, so let's do this. Let's say from this breakout of the red lines here, if I really felt that, hey, the next level of support was here, well, I could measure this distance and say, okay, well, my potential reward is going to be $10. Let's just say that, $10 per share. And then if I look here and say, okay, well, where would I place a stop? So probably directly under this trough here would be where I'd place a stop. And so I would measure that and say it's $5. Well, I've got a 2-to-1 reward to risk ratio, and that's great. But if I'm working with a scenario where maybe my gain, my potential gain, before I think I'm going to hit support and possibly have a reversal in the market, is only $5 and my stop is $10 away, well, then I'm running, 2-to-1 on risk to reward, and that's just way too high. So these are things that we've got to watch as well to make sure that when we're setting targets and using targets, that we're really thinking clearly about, well, where's my stop? Where do I think the price is going to go? And then what's my risk to reward ratio based on that? All right. So the next part of here is stops that we're going to talk about. And the first one here is what are entry and exit stops. So again, you may be very familiar with this. Essentially, a stop is an order placed with a broker so that as soon as price hits that, you are out of the market. And so it's really a limit order that's put in. So you're putting in a stop, it's a limit order, but as soon as that price is triggered, it becomes a market order. Now, why that's important, and do remember this, so on the exam you will get questions about this, but why that's so important is that when you get your stop, you're not guaranteed to be filled at that stop. If price is moving rapidly down and you have a stop there, and it even gaps down, well, you're not going to get that filled because you're selling and there may not be any buyers at where you set your stop. It's probably going to be lower. And that's why it's understanding that it may be a limit order when you put it in, but once that gets triggered, it turns into a market order and you are out wherever the broker can get a fill for your order. And so you do need to make sure you keep that in mind. Exit stops are used to protect capital from further loss and to signal that the trader is wrong. We are going to be wrong nearly half the time, hopefully. More than half the time, gee, you better have some good money management rules. What we want to try and do is to get better than half. If you can get right more than half of the time, and you can wrap that with really good money management rules, you are going to do fantastically as a technical analyst and as a trader or doing analysis. Your calls are going to be good. Nobody should expect to be right 100% of the time. That's where people get really disillusioned and then walk away from the market because they can't handle this fact. Entry stops are used to capture confirmed breakouts. So we talked about the breakout ranges. We can put a stop on either side. We may go long or short depending on what happens. We can have an order basically on either side bracketing that range, and once it's confirmed, the trade's in the market and we're away. Stops should never be moved away from the trend. So if the trend is going up, we've got a stop sitting here. Well, as time goes on, you should bring your stop up higher and higher. And that is to lock in the gains from holding the risk or the exposure to risk. Holding a position always has risk associated with it, and you better be making money to compensate you for that risk. If you're not, then your strategy's bad. So stops should never be pulled away so that you increase your loss. If you get stopped out, you're stopped out, you go and look for another position to trade. Can't really reiterate this enough. I see too many people who are holding positions and it's basically tying up their capital so that they can't go out and find another trade. B, from a psychological point of view, it's demoralizing to have losers in your portfolio and sit there and say, well, hopefully it'll come back, or maybe I'll double down and also average down and buy more so that my actual loss is not so bad on the books. And I've got to say, I've done all of that, and I know how demoralizing that can be. So important to be very, very strict and disciplined about the approach and say, stops hit, I'm out. And you don't even enter a trade until you know where the stop is going to be. And that's very clear and concise rules about this. You don't want to have your stops so close that you keep getting stopped out. If you haven't got the capital to sustain a proper technical stop, then you need to find another security to trade. There's plenty of securities in, for instance, if trading the S&P futures was too much risk, you couldn't sustain the loss, well, you go to E-mini, or you go to an ETF, or you go to something else where you can sustain it. It's being smart about the market that you're trading and the amount of risk that you're carrying as well. Protective stops, basically, is what we talked about. I think I've just reiterated all of that. The other important thing there is by setting stops, you know your risk. You've basically locked in your risk to a certain extent. Again, there's that situation of the big gap, which can happen. There's systemic risk, and we're going to talk more about that later, where there is just a major event, a 9/11 type event, which causes major drops in the market. And these are things that we can't avoid. We just can't diversify these things away. But nevertheless, these are things on a typical normal market structure. Your stop allows you to know, well, what is the risk? How much am I risking here? What's my exposure here? What's the risk to my portfolio? The other thing here, this is a really good one, this last point. All stops should be placed where a reversal of the trend is confirmed. There's a whole adage of cut your losses quickly, but let your profits run. That's the ideal trading scenario. Unfortunately, what so many people do is they let their losses run because they don't want to galvanize the loss. They live in hope that the market will come back up and return them to profit. And when they have a profit, then they're just like, oh, I want to lock that in. I want to lock the profit in. And really what we've got to do is the opposite. We've got to have the stop there. Basically, that stop is telling me if I get hit, then there must have been a reversal in the primary trend. And I must be wrong, and I've got to rethink my whole point about where this market's going. And so that's having it at a good distance away from the market. If I'm too close and every secondary reaction is stopping me out, well, that's not good either. But ideally, we let our profits run, and that's why we use trailing stops as well. So, with trailing stops here, it's a stop that follows the market. It can get closer to the market, but never moves away. So they're like a ratchet, where as time goes on, they're getting closer and closer and just following it. Very simple one, trend line. We can have a trend line on the troughs of the market. And then a little area beneath that, we can have a parallel line and use that one. So in this case, we'd use the red line as our stop, while the green line is our trend indication there. Very simple there. A couple of technical ones that we use. The chandelier stop basically uses the ATR in its calculation, and so just measures ATRs off the low. So calculating that volatility, a couple of units of volatility, or we multiply the ATR by a value. Sometimes we say 2 ATRs, which means we get the calculation multiplied by 2, and that becomes the stop beneath the low. The key with these things, though, is that as the market starts to drop, we don't bring the stop lower. As we said, the stop stays where it is or gets closer to price. And you can see that on this chart, where the blue line is just getting closer and closer to price until it's finally triggered. Most of these type of tools, you'll see they basically stop and then they reverse, or stop and reverse we call it. And so it goes from the blue line to be the red line, looking for shorts and giving you a short stop now. Another example of that is the parabolic stop and reverse. Sometimes we just refer to that as PSAR. But this one uses an acceleration factor. So Wells Wilder came up with this, has an acceleration factor, so the longer that the trend persists, the acceleration gets bigger and bigger. And that's what gives it almost like an exponential curve as it gets closer and closer to price. Now, Wells Wilder's theory was this whole thing of trends. Basically, they have a certain amount of life. You know, there's only a certain number of days where a trend is going to continue going up higher and higher and higher and higher until we get some sort of reaction. And that's what this tool tries to capture. The longer we go, the faster it gets up closer to price, and then reverses on that. And you can see how that tool works there. Doesn't consider volatility. It is subject to whipsaws. Really nice in strong trending markets, not so good in sideways markets. So, you know, overlaying this with some sort of trend indicator is probably a good one to use. Swing stops. So we talked about in charting, we talked about the basics of swing charts and how they're really a trend detector. You know, when the line's going up, then the trend is up. When the line's going down, then the trend is down. But we can use these, and a lot of people will use this whole concept for using stops and for trading in the market. So right here, you know, what we're looking for as a signal is we've got a high here in the swing. When that swing has been taken out, right there where the green arrow is, that's where we would enter the trade. And at that first trade, we would have our stop here under number 1. Market goes up, retraces as we expect. We're a little bit underwater here, but that's fine because our stop's back there. We haven't moved our stop. And then we go along. And as soon as it takes out this high, well, then we move our stop up to this point. And we go up, we go back down again, and we move our stop to here. We go up, back down again, move our stop to here. Now we're actually in profit on this trade, and then back down again. And then finally, when this stop here got broken, then we get stopped out of the market. So, you know, again, these sort of strategies for using swing stops, they work really well in strong trending markets, not so good in sideways markets. Just making sure that I've read all my notes there. All right, time and money stops. Essentially, a time stop is saying, I'm going to stay in this trade for X number of days. You know, it's really interesting. We had an interesting discussion here between two of our staff where, you know, one could not believe that you would not put a stop in on a trade, where the other one was saying, well, from a quantitative point of view, I know that after so many days is where I get my peak return. You see, what he was saying was, if I've got, let's just think about it, returns, you know, returns that I get from a trade. If my average return goes up for like this for about, let's say it's 14 days, and then starts to flatten off on average, well, my peak return is at 14 days. So his point was, I don't want to hold capital beyond 14 days if I can take it out and then go and find another opportunity, which on average is going to have that steeper return. And so he would always use time stops and say, 14 days, that's it, I'm out, based on this technique that he was using. I'm not sure, I'm a little torn on this. I understand exactly where he's coming from a quantitative point of view. Time stops do make a lot of sense, and I think there's an element of the longer we hold money in a mediocre trade that's going nowhere, we may as well cut the losses and get out, or cut the moderate gains or the break even. You know, we just want to get out and say, right, let's go find another opportunity. We don't want to tie our capital up. We don't want to be exposed to risk longer than is absolutely necessary. It's, you know, the other school of thought is obviously put a stop behind the trade, and I think there's a case for both. Where this whole discussion ended in our office was, yes, that makes sense, but you really still need to have a disaster stop. Where's that stop going to be when things just completely go south? There's a massive issue in the market, and we need to protect our capital. The other one is money stops. Basically, it's determining essentially how much money can I lose, and so I set my stop based on that. this is a terrible way to set stops. You know, it's not really what we would want to do. You know, again, I think from an exam point of view, you need to understand what a time stop is, what a money stop is. But this, if, you know, in reality, if you were using this and saying, well, I can only afford to lose $1,000 or you know, $10,000, so that's where my stop is, you are trading the wrong instrument. You need to be looking at instruments where you can be doing this on a technical basis from your testing and your quantitative approach to the market, and setting your stops that way. Setting it based on your capital just says that you're working with the wrong instrument. All right, percentage gain stop. In this one, it's basically looking and saying, let's take each impulse move up and we'll set a stop based on a percentage coming back. And really where this theory goes is that on successive moves up, we are expecting, hang on, let me rephrase this. Once we've had like 3 or 4 moves up and the primary trends persisted, the likelihood of a change of trend becomes higher and higher. You know, and there's some analysis we did on swing charts where we're looking how many swings in a row can we get. And some markets will get up to 13, 14 swings in a row, but that's very rare. So what we found is that once you get to like 3, 4 swings up, the likelihood of a change of trend becomes really, really high. And so that's what this idea is saying. Okay, on my first swing up, I'm going to have a huge retracement. If you have a look at this chart here, let me get my cursor. So you can see here we had our first run up and we measured down, and I can't quite read what level I've put there. I mean, it looks like a 75% retracement. And so, you know, that could be what we would allow on the first one. But on the next move up, we may say, right, well, now I'm only going to allow 50%. And then on the move after that, well, I'm only going to allow 25% because my expectation is that the market is going to roll over soon. And so that's how percentage gain stops are used. Again, not really common, but just something that you need to be aware of. So using stops with breakouts, essentially when we have a range, and we're going to talk a lot about this in bar chart patterns, you can have a stop sitting outside of the range. Now this is a classic example of where, you know, we can have the stop and the stop may have been at, let's say, $94.50 or $94.20 or something like that, but the market moved. You know, the market opened way down at 91.50, so our stop order, our limit order, would have been turned into a market order and we would have been filled at 91.50, which again, you can see that that really wasn't so great in our case. So again, got to understand that thing about stops, but the orders on either side of a range can be used to catch breakouts and get you into the market there. But in this case, you can see that it was too late by the time we got into it. So that's breakouts and stops that we're talking about here. You know, it's just really important that you can identify what a breakout is, basically recognizing the signals that identify breakouts. So the thing about volume, the diminishing retracements as we approach, and just sort of what sort of things we're looking for, targets, etc. How to forecast those as well. You need to be able to know entry and exit stops. So basically an entry stop is just an order, limit order waiting in the market, which will be fulfilled. A stop is a limit order which gets you out of your trade. But do understand that thing that it changes to a market order. And then all the different settings for ways that you can set stop orders as well. So that's breakout and stops, and we will continue in the next session. Thank you.